I've been calling for this market, this current market environment, which we believe is as record valuations for the S&P 500, especially these mega cap growth stocks and mega cap tech in particular. I don't know if this is it or not, but it kind of seems to me like we might be seeing the technical signs of some market topping action here. It's, I know this chart's kind of small to see the candlestick bars on this, but last Thursday we had a bearish engulfing candle, and now that with this Friday with the market down, it's going to be a bearish engulfing week for the S&P 500. So bearish engulfing daily candle. Go on to the next. Also, this bearish engulfing weekly sort of formation that kind of reminds me, if you look back, you can see that other top that we had back at the end of 2021, the very beginning of 2022. It's very reminiscent of that false start that we had. It wasn't a total false start because we had a great year in 2022 on the short side of things, and I think we have another great year ahead here. So let's keep going. This is, further illustrating. This is showing the market breadth, and so the S&P overall is kind of making that top. But look at what's going on with the breadth of the market. It looks like just what we saw in mid to late 2008, right before that big flush that we had. And we are at those same kind of levels as we were in the middle of 2008 when it comes to breadth. So we're looking at the equal weighted S&P 500 here versus the overall S&P 500. And this is one of these great, B of A has just been killing it with their macro charts. I'm sure you've noticed Tavi uses them a lot, and they have some great charts. But so pay attention. This is an important, we think advanced signal, and I'll show you what's the further fundamental and macro setup for that. But so let's go on. So commercial real estate. This is really the elephant in the room right now, is the commercial real estate market, and this is just looking at the net operating income for commercial real estate properties. You can see that the office market, of course, is already into the negative territory consistently here for a number of years post COVID. That's the leading, that's the commercial sector that's leading things to the downside. But notice that apartments have also turned into the negative, and that's been a new emerging trend the last several quarters. We've seen problems with the B REIT, the Blackstone Real Estate REIT, now the S REIT, the Starwood REIT. So the commercial real estate market is really a big warning signal here. Why is that? Why does that matter? It matters because a lot of this debt, is going to need to roll over soon. Let's go on to the next here. And this is, before we get to that, this is just showing also the vacancy rates. Vacancy rates, you can clearly see in the office area, just, we're, 19% vacancy rates, and this have just continued to climb in the post-COVID era. At the same time, you can see the vacancies starting to turn up in industrial and of course in apartment. So let's let's go on to the next here. So what's going on? How come we don't have the delinquencies showing up yet in commercial real estate loans? And this is what everyone is worried about, that we're going to start to see defaults and delinquencies. That's why the massive redemptions going on at the B REIT and the S REIT. Investors trying to get their money out ahead of this, and these funds have had to throw up gates, I believe. But here, you've heard Jamie Dimon talk about it, and of course the guy who runs Starwood, blanking on his name right now, but so you got the watch list. Look at how the watch list for delinquencies is The watch list for commercial loans has been substantially on the rise, but we haven't seen the delinquencies yet. Normally, the delinquencies, then the defaults, but the watch list is the advance indicator here, and we've already shown you what the underlying fundamental problems are. The problems are interest rates are substantially higher than in this cycle. The Fed has been forced to hike rates to fight inflation, and the commercial real estate market is the one that is about to feel the pinch. Let's keep going here. Chicago PMI just came out, and the Purchasing Managers Index. This is one of those survey economic surprise data indicators that's showing the stag and the stagflation. And here we are. Chicago PMI just came out in recessionary territory. That's the stag. And yet, we also continue to have the inflationary pressures. That's why the Fed has not been able to lower rates yet. We came into the beginning of the year, everyone expecting up to 6 rate cuts by the Fed, but they haven't been able to. Why? Because the economy's still been moderately strong, but now you're seeing the stag. So they're getting their mojo ready to do the rate cuts because we have the stag part of it, but the inflation part of it hasn't gone away, and that's the problem. The Fed is going to be cutting rates into a highly inflationary environment. This is potentially explosive for gold and for other commodities. Let's go on to the next. So what happens when we get that first rate cut? I mean, people are saying we got the pathway, or the door is open now for that first rate cut. Well, if the last 1, 2, 3, 4, 5 times we've had that first rate cut, what's it been? It's been almost immediately the signal of the start of the recession. And further, and that's what the numbers in this chart are showing. The number of months after the first rate cut until the beginning of the recession. Okay, and especially the last five business cycles, the last 5 recessions. That's what that first cut signaled. The first cut also coincided with the beginning of the bear market. It wasn't the beginning of great times and new bull market ahead. No, that first cut coincided with the beginning of the bear market and the onset of the recession. I think, do I have any more, Nathaniel? Okay, one last, and here's the punchline. So we all know, and Tavi's going to give you the whole macro presentation preview of our letter for why hard assets, why this is the best macro setup that we've ever seen in our careers for a major hard asset bull market. This is just showing global international reserves. I love this chart because it's showing among central banks, the proportion of gold relative to the proportion of fiat currencies that central banks have been holding, and you can clearly see the U.S. dollar proportion of U.S. international central bank reserves has been shrinking, and it's been shrinking consistently now for several years at the same time as gold's proportion of global central bank reserves has been increasing. And this is just part of the entire setup here for why hard assets, why commodities, why precious metals now